Well, let's turn to investment strategy now. And our next guest practices safety first investing. To tell us all about it is Rob Shears from Valor Private Wealth, and he joins us now live. Rob, great to chat with you this morning. Now, someone tells me that you're an airline pilot as well, so risk management is your thing, I hear.
Absolutely, yes. I'm an international airline pilot on the A380, as well as an investment manager. So we have a very unique perspective of risk. So a lot of other investors are looking at the upside and not necessarily factoring in potential downsides along the way to protect clients' long-term wealth.
Yeah, so what is safety first investing then?
Safety first investing is all about thinking about the safety of capital over the medium to long term. We're not so worried about ups and downs volatility. It's about permanent wealth creation and avoiding permanent losses is what we're looking for. And we've got a number of techniques which are derived from aviation safety practices, which we use, and we don't think that many other people use our techniques.
Yeah, so walk us through some of the most popular ones.
Look, first of all, we have a similar idea to pilots. Main objective is to get the airplane to the destination safely and be able to reuse the plane. We also have the same sort of idea with our investments. We want our investments to be there at our destination and make a return greater than the long-term risk-free return. But most importantly, to be able to do that, you need to know the business is going to be around and doing what it's doing with higher earnings in 5, 10 and 15 years' time. So you have to have a really high quality investment. Has to be reasonable value. You can't overpay. One of the things that we do that very other few people do is what's called capital independence. And that's making sure the company's never going to be forced to raise capital under duress. Now, if you think about that, most companies raise capital during difficult times. So more than half the companies in Australia raised capital at the bottom of the market in 2009. We just won't touch those things. And finally, we want managers who eat their own cooking and manage like it's they're the pilot on the plane. And pilots have more skin in the game than almost any other manager because their lives are at stake as well.
And so, Rob, does that mean that you're looking at? I mean, I know you love international companies. Does that mean that you're looking at stocks like the FANGs?
Yes, we own some of the FANGs. We think some of the FANGs are potentially overvalued, which doesn't factor into that safety key element, which is if you overpay for something, it can be worth a lot less in 5 years' time. So look, we think that Facebook's not overpriced at approximately 21 times next year's earnings after cash. It's not overpriced. But you look at the assets they own, and then the potential to monetize some of those assets which are not yet monetized. Facebook's still got a long platform for growth, Instagram being one of the best businesses in the entire world.
And what about something like Amazon?
We like Amazon, particularly at this price. Amazon, AWS being the profit machine, Amazon's trading at a bit less than 20 times next year's operating cash flow. So whilst it spends a lot of money on reinvestment and it looks expensive on its earnings, its reported earnings, it's actually not that expensive when you look at its cash flows. And with AWS still growing at 37% per annum, we think that cloud infrastructure growth has solid growth for 5 to 10 years, and Amazon's going to do very well. The other thing about Amazon is that it's only approximately 30% of Amazon's earnings are international. So it's got a long platform for growth globally. And if you look at Australia, Amazon was not great a couple of years ago, but now it's becoming a dominant player again in Australia. And if you want to buy something, Amazon's probably going to be the cheapest place to buy us now, now that it's established its network effect of all the distribution centres in Australia.
Well, Rob, talking of companies that are still likely to be around in 5 years' time, Ambev is on your list. Tell us a bit more about the company. I understand it's one of the most dominant beer companies in the world.
Yes. So, look, beer companies can be good, not great businesses, generally speaking. And that's because of competition. Whereas Ambev has a 2/3 market share in some of its major regions in South America, and it also does Canada as well. So it's effectively selling beer to commodity countries, Canada being a commodity country as well. So there's the potential triple tailwind from an already dominant player. They have potential for higher currency, for commodity currencies, selling more beer and selling higher volumes of beer, and also premiumisation of beer as wealth potentially grows in these commodity countries. Obviously, the Chinese property risks are obvious and real, so that could make a dent in that medium-term growth. But we think that even with a difficult China over the next couple of years, there's still long-term growth built in at this price. It's only trading at 17 times next year's earnings after cash, and it's got 2.2 billion in cash for a 46 billion share price. So it's a net cash of 2.2 billion. So it's very well positioned and conservatively priced.
Rob, given your status as a pilot, what are your thoughts on the travel industry and I guess the wider aviation industry as a whole, given this reopening play?
So, look, we think that aviation is ripe for a fairly strong comeback. Surprisingly, a lot of stocks have already got that priced in. If you look at something like a Ryanair, which we previously owned pre-pandemic, made 70% return in 4 months and then sold it at 16 euros. It's now trading at 17.34. So, there's things like Ryanair, which are trading at a higher price in the middle of a pandemic than it was before the pandemic. And we don't think that makes any sense. But we own Safran, which is trading at about a 30% discount to its pre-pandemic price. But people forget that pre-pandemic, the 737 MAX wasn't flying. So as these aircraft are recertified and the MAX is now recertified, the growth of Safran over the next 5 to 10 years, and we don't think this is just a reopening play, with this, think this is a medium to long-term growth story. There's 4,500 orders for the 737 MAX still. Remember, there's 2 engines per 737, and there's 6,000 orders of the A320, and they've got about a 60% market share on the A320. So there's many thousands of engines still to be put on aircraft, and Safran is going to collect a large amount of profits from that over the next 5 or 10 years.
Hey Rob, I know you guys have got a position in Magellan. How's that going? You're looking to add at the moment?
Yeah, so we bought Magellan after it dipped about 25%. We thought we got in a fairly reasonable price. It's dropped another 15 to 20% since we bought, and we're looking to potentially add. If you look at Magellan, there's obviously the core international fund business, but that's not the whole story. They also have their infrastructure fund, and the Airlie funds management business actually did very well last year. So they've grown rapidly, massively outperformed the market last year. So they've got a solid tailwind behind them. But equally as important is the probably now over $1 billion worth of non-fund management assets, and they're non-core assets. If you take those assets off the price of Magellan, it's trading about 13 times next year's earnings, with $18 billion under management, and you do approximate calculations. Magellan at 13 times earnings is just too cheap.
Rob, always great to chat. Thanks so much for joining us this morning.
Thank you very much, Cara.